what's up? I just want to make a quick video. I don't normally do this at all, but I don't have anybody I can call to talk about the situation that I see our financial institutions and government in right now. So over the course of the last, I would say 6 months, I've been liquidating my savings account from numbers on a screen to hard precious metals. And I would pretty much recommend anybody right now to do this. I'm basing this off of how volatile the stock market looks right now. It has looked for about 2.5 months. And if you push back the date about 10 years, if you look at how the stock market has increased dramatically over the last 3 years, it looks superficial. Everyone that I talk to goes, well, Alex, how can things in our economy be this bad if the stock market is rising to absolutely insane new heights? And my answer to that is, of course, the stock market's going to raise to new heights. There's been tons of money funneled into the stock market. I mean, since 2008, the amount of dollar bills in rotation has doubled, right? So in 2008, there was about $11 trillion just floating around. And now we're looking at about 22. So there's twice as much money in rotation as there was in 2008. So of course, a large portion of those dollar bills are going to find themselves in the stock market. So you can't really trust a rapid increase in the stock market, because those numbers are certainly going to go up if there's more dollars in existence, right? So the way that I see it is the stock market is probably a bubble, similar to the housing market bubble, except that housing market got pushed into the financials and the auto industry. I think the auto industry was the first bubble, and the first insight I had on that was right after the 2007-2008 housing market crisis. At the time, I was pretty young, and I remember I had a couple dealership accounts at the time, and that's when they were doing cash for clunkers. And the first thing that went to my head was, well, if the banks are, the banks operate off of interest. They make their money off the interest. They loan people, and that's how they make their income. That's their business, is the interest. That's their bread and butter, is interest. Well, they had obviously squandered away the majority of the funds that people had put into the banks, and they were risking collapse, which means depositors, the people that put the money in, you and me, were at risk of losing our deposits. We were at risk of losing our assets, our cash money. It was going to disappear if these banks went out of business. So the government decided to bail these banks out. I think it's important to state that the government itself doesn't actually have any money. The government doesn't hold money. Government's revenue is based off of tax. So technically the government didn't bail out the banks, the U.S. citizens did. So the people that the banks damaged the most ended up saving them. And the way they did that was the Federal Reserve ran a couple rounds of what's called quantitative easing, or QE. And quantitative easing is pretty simple if you just look at it like the Federal Reserve creates a large quantity of money to ease the economy. Quantitative easing, it's that simple. And they've done 3 rounds of quantitative easing, and had they had not done this, we would have seen a very major recession, significantly worse than the one that we went through in 2008, possibly much more devastating. In my opinion, I really don't know what they should have done at that time, because they've already messed up the system since the 1980s. So the Federal Reserve had saved recessions, or at least eased recessions, over the last 40 years. And when the housing market bubble collapsed, They really didn't have another option. That should have been a knockout, an absolute knockout. So what they did is they basically saved us a decade to possibly figure it out. It's either the United States goes bust now, or we sacrifice the possibility of insane inflation in hopes that maybe we fix the problem in the next decade. Well, they never really did that. They never really fixed any problems. There's a couple reasons for that that I'll get into later one day, maybe. I guess the point that I'm trying to make is I'm staring at the stock market and watching how volatile it is. It's about time for it to decrease rapidly. And the odds of it being a minor recession, I feel are slim to none. And this is an opportunity. It's a terrible, terrible opportunity in which if you are paying some sort of attention, you're able to make a lot of money off of this safely. So let's just assume you have $100,000 in your savings account, and you liquidate 50% of that, and you take $50,000 and you go and you buy gold bullion with it. I prefer gold eagles. They're beautiful coins. I prefer those because they're easy to liquidate. 1 ounce gold eagles. You wouldn't want to buy bars. They're easily counterfeited, and then during a recession when nobody has any money, it's very difficult to liquidate a gold bar. So you want to buy as many gold eagles as you can, and usually you pay a premium for them. So say gold is $1,200 an ounce. You're going to pay $1,270 for it. So you're going to take a $70 hit right off the top of purchasing your gold. So there is a downfall, but it's a very small one. And in my head, I've invested at this point about $50,000, and I'm going to go start liquidating more cash this week to get to somewhere around $80,000. It's going to cost me somewhere around $8,000 in premiums to do that. So for me to liquidate or transfer or change over my paper currency into gold assets, gold bullion coins, it's going to cost me somewhere around $8,000. Now, say I'm wrong and the stock market recovers. Worst case scenario, odds are at this point gold isn't going to go down because it's pretty much at its bedrock. I mean, you have a lot of gold manufacturing and mining companies going out of business because it's too expensive for them to mine gold at the price that it's at. So odds are it's impossible for it to go down any further. So it's on sale. So worst case scenario, the economy recovers, and if it does, awesome. I'm out $8,000. I can go exchange my gold for hard cash again, throw it back in my bank, no big deal. But if you look at the charts from 2007, I think somewhere around 2006, 2007, gold was about $600 an ounce. In 2011, it peaked at I think 2,200. That's somewhere around 300% increase, 350% increase. So let's just say it's half of that. Let's say that we have a minor recession. Panic isn't as high as it was in 2007. Let's just say it's half. That means that half of 300% is 150%. That means that your $80,000 investment, or say $50,000 investment, is going to be worth about $125,000. Now, technically, it's the same value in purchasing power. That $125,000 in that kind of financial climate is worth the same as the $50,000 you originally invested. But because there's a dramatic lag time between society and how they view inflation, there's a significant amount of time to turn around and take that money and buy things on sale. And I'll use an analogy of a $10,000 piece of property. Say there's a piece of property at $10,000 when the stock market's high, right? So, somebody puts the acre up for sale for $10,000. Well, if the stock market plummets and that acre is still on sale for $10,000, there's going to be less buyers to purchase it because everyone's out of hard cash, everyone's panicking, and for the most part, there's going to be less eligible purchasers for that $10,000 an acre. So it might go on sale for $7,000. Now, if you've taken your gold and you've converted it, or if you've taken your hard money, you've taken your money and you've converted it to gold, and you sell it off right around this time, now you've made a 100% return if it's not a bad recession, right? So your $50,000 turned into $100,000 or $125,000. So now you're looking at purchasing a piece of property because the person that's selling it, odds are they don't understand that inflation is gone through the roof, and they're kind of in panic mode themselves, and they're just looking for enough cash to facilitate their normal lifestyle that they're used to now that things are more expensive. They're going to be putting things on sale. So you're going to be able to nab up a large portion of real estate for relatively cheap. And the way to expand your assets rapidly is by purchasing these up at very low percentages if you calculate in the money you made off of turning your dollars into gold. I may not have worded that right, but that's pretty much what my plan is. In worst case scenario, you lose $8,000. And if you've got $100,000 in savings, odds are you make about $8,000 a week. So what is a week's worth of labor, of work, to invest in the possibility of dramatically increasing your assets? And that's how I looked at it. So that's where I'm at. That's pretty much what my game plan is. So yeah, that's the video.